a pretty significant development coming in as far as Apollo Hospitals was concerned. The company went ahead and announced a corporate action where they, planning to demerge the healthco and the diagnostic business into a separate entity. To talk on this and a lot more, Kunal Dhamesha, who's the pharma and healthcare research analyst at Macquarie Capital, joins us. Thank you so much, Kunal, for joining us. First up, what do you make of this particular deal? How does it impact the valuations of Apollo Hospitals? So far, analysts were concerned that it was not getting the valuation it deserved compared to other hospital stocks. Does this now free up space?
So, this separation of the pharmacy business from the hospital business, I would look at it from, two angles. One is from the existing investors angle. I think nothing changes, much from the existing investors angle, because they were already part of the journey on both of these businesses. But let's say when this new business gets listed, that changes any new investors who just want to take part in whether hospital business or in the pharmacy business. It makes their life much easier to choose which secular growth tailwind they want to be part of. Apart from that, on the valuation front, there is a belief that Apollo Hospital used to get a discount versus the other hospitals.
Right.
As far as I am concerned, I value Apollo Hospital based on SOTP, and within that I value their healthcare business EBITDA at par with the other Indian listed hospital peers. So for me, there was no holdco discount, etc., that I was implying within the overall Apollo Hospital valuation.
Kunal, the company has a target of around 25,000 crores and margins of 7% by FY27. Do you think that is quite aggressive? What do you make of different entities and the entity altogether as well right now?
So I would highlight that the target in my view is aggressive, and I think they also kind of understood that it's an aggressive target. This target was first put out when the Advent deal happened sometime last year, when Advent infused $300 million in the business. At that point in time, the company had suggested that this combined pharmacy business would do revenue of 25,000 crore by FY27. And they had suggested it would do 7% EBITDA margin on pre-Ind AS 116 basis. Now, when I look at the current announcement, what has changed is the revenue target of 25,000 crore is now being put out as the exit run rate on FY27. So FY27 is expected to be lower than that. So I think the top line guidance has been lowered to that extent what we had got last year. For the same business. And then the pre-Ind AS 7% EBITDA margin target, which was shared last year, has now been changed to post-Ind AS EBITDA margin target of 7%. Now, important thing here is, because of the fundamentals of the business, there is a difference between the pre-Ind AS EBITDA margin, which would kind of take out the rent expense from the EBITDA, versus post-Ind AS, the rent expense moves to depreciation and interest expense because of the lease accounting. And hence, I would say effectively, this now post-Ind AS guidance of 7% EBITDA margin is a downgrade from earlier pre-Ind AS EBITDA margin guidance of 7%.
Understood that, Kunal. Thank you for explaining that very clearly. Kunal, also one thing which you want to understand is, just stepping at a little bit from Apollo Hospital, you called FY26 as the year of capex as far as hospital chains were concerned, and you said that there was a good chance that return ratios could be compromised. Most of the companies, wherever they've spoken in conferences, have actually said that capex expansion will be done along with maintenance of return ratios. Your view, and what are your top picks in this particular space?
So I would say, if I look at the top 8 listed hospital within Indian market, the management of these hospitals have guided to add almost around 15 to 16,000 beds over the next 3 years, right? And this expansion is roughly 4 times of what these same companies have done in last 5 years. So last 5 years, they've added 3,400 beds. Now they are guiding to at 16,000 beds. So one, the next 3-year expansion is very large. Secondly, the ARPOB growth, which used to be very high between FY19 to FY24, the CAGR has been almost around 11%. That has now moderated in FY25 for most hospital to its historical range of 6 to 8 percentage point. So my sense is that the margin expansion which happened during the last cycle because of strong ARPOB growth, etc., is not going to sustain going forward, and hence the profitability in the existing hospital might not improve as much as we have seen in the last 5-6 years. And then new hospitals being high fixed cost business will initially put some drag on the profitability, because any new hospital typically breaks even at around 45 to 50% occupancy level. And before that, it causes EBITDA drag. So my sense is there will be profitability compression, and that would translate to ROC compression while these new hospitals ramp up.
All right. Thank you, Kunal, for joining us and giving us your take on the hospital space and in particular Apollo Hospitals. With that, we'll take your leave on this edition of Midcap Radar. Stay tuned, your stocks when we return.